Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, May 2, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So we have a lot to talk about tonight. We had a lot of action today, even though at the end of the day, it doesn't look like much. The S&P was down a little bit. The transports were down. The Dow was down a little bit. It seems like an uneventful day, some profit taking, whatever you want to call it. But there was some stuff going on. So let's kind of decipher and see if we can put the puzzle pieces together to see where we head next. So last night, we had Apple earnings. Apple reported their numbers. The stock shot up. It brought the NASDAQ up with it. The stock stayed up, meaning Apple stayed up throughout the trading day today. However, the other markets rolled over, and I think that's significant. And there was another piece to the puzzle. We had the Fed announcement today. The FOMC at 2 p.m. today had their interest rate announcement, and they did nothing. Now, that was fine. Everybody expected them to do nothing. Nobody expected a surprise. In fact, the Fed's not in the business anymore of issuing surprises to the markets. A long time ago, when Alan Greenspan was head of the Fed, he used to leave everything a mystery. He used to talk in half code, and you had to guess whether he was going to increase or decrease interest rates, what he was going to do, what he was going to say. The Fed got out of that business with Ben Bernanke and Janet Yellen, and what they've decided to do, which I think is the right move, is they've decided to kind of project and tell everybody exactly what their intentions are. So there's no surprises. The Fed is unlikely to jolt the market because they raised interest rates by 0.5% when the expectation was for them to do nothing. That's unlikely to happen anymore with the Federal Reserve. Whether we need a Federal Reserve is a whole nother picture. It's a whole nother discussion. I don't know why. I never could understand why we can't just let the market dictate what interest rates are and whatever else the Fed has its hands in. The market can certainly do that on its own. The market will always find price discovery, but we don't let the market do that a lot of times. We have the Fed, therefore we have to justify the Fed's existence by putting them in charge of interest rate policy, and therefore they're in charge of interest rate policy even though the market sets the rates at the end of the day. So where are we on the Spider? So there's a couple of things going on. The question is, or at least one question I will ask is the ABC pattern off the table? And this is the ABC pattern I was discussing. So we've completed the A and the B leg, and my theory was that we were starting at the bottom of the B leg. We were starting the beginning of a C leg that could take us all the way up into that zone here, which could provide a nice selling opportunity at resistance of this downsloping trend line. That was item number one. That was a roadmap that we've had our eye on for the last several days. Now that roadmap starts to come into question. Where does it come into question? Really from last Wednesday's low. Any day that we were to close on the daily chart below last Wednesday's low, then this ABC pattern is off the table. In fact, closing below last Wednesday's low would be a really, really big negative for the market, and I think that would bring lower prices into play. I think it would bring this pivot low into play. I think it would bring this pivot low into play, and I think it would bring the lower numbers that we've been talking about into play down either at 250 or below as a target for this corrective move. The way I'm looking at it right now, everything is predicated on staying above last Wednesday's low on a daily chart closing basis. That means intraday we can trade below that pivot low, but we have to close every single day above last Wednesday's low or that ABC pattern is off the table. So then the other question becomes, if we stay above on a closing basis last Wednesday's low, and even if we come down to test it, let's say tomorrow or tomorrow into Friday, We come down and we test last Wednesday's low. Maybe we get there. Maybe we spike through it by a little bit, but we close above it. Does that take the ABC pattern off the table, or does it still leave intact the pattern that we've been discussing? It leaves it intact. That's the answer. The answer is, until and unless we close below last Wednesday's low, this pattern is still activated. It's still possible. While as the days go on, it may become less and less of a probability. It's still a possible pattern that could play out on this chart. Why do I say that it has less and less probability? Well, because until and unless we can close above the high of this breakdown candle from the other day, and that breakdown candle is from the 24th. Let me just double check. Yep, the 24th of April. Until and unless we can close any day above the high of the candle from the 24th, then this market still has downward pressure. The energy that was to be released on the upside with the completion or the would-be completion of the ABC pattern, that energy can certainly be released on the downside. If we don't get going and we stay beneath the 20, obviously we're beneath the 50 and the 100 period moving averages. We only have the 200 period to hang our hat on, and we've been back and forth through the 200 period moving average enough times where we know that this particular trend line, this particular support line as it was once called, is diminished. The more times we hit on a trend line, the less important that trend line becomes, in this case in terms of support, and the flip side in terms of resistance. So right now we're below the moving averages. This market looks like it wants to go lower. That's what the prevailing wisdom would say. If I had to take a trade and you had to pick a direction and I had to either be long or short the market, which one would I have to pick? If I had to pick, I would have to pick short. But right now I'm reluctant and I never like to short in the hole. And what do I mean by in the hole? Well, let's say we open up down here tomorrow. We're down in that zone. Okay, you're right above the 200 period moving average. We know that a daily close below last Wednesday's low is bearish. Okay, so let's say we start testing those levels, and we want to anticipate that the market's going to get below, stay below, and close below last Wednesday's low. So we buy some puts, or we short the market in some way, shape, or form. We buy an inverse leveraged exchange traded product. Well, then what happens is all of a sudden we find support, the market rips higher, and we're out of the money pretty quickly, and we have to cover the position or unload the position, and we've booked the loss. And the reason that we did that is because we became increasingly impatient. We anticipated something that we thought would happen. That thing was a close below Wednesday's low. You can only determine that the market has the highest likelihood or probability of going lower with a close below last Wednesday's low. Now, I realize that once we're already there, the following day, there may not be a lot of meat left on the bone. The market may come down another decent amount, leaving traders that wanted to be short in a lurch. I get that. That happens all the time. Welcome to the market. Sometimes we're able to hop on a trade and trade in the direction that the short-term trend is headed. Other times we're not able to because it's not a prudent decision, in some cases, to sell a market in the hole, for example, or buy a breakout. Sometimes we can, but sometimes we can't, and you have to know when to hold them and when to fold them. And this is a scenario right now where I would not sell a breakdown. I would not short the market in a hole. What I would do is I would wait for the market to get down to 250, 251, 249, somewhere down in this neck of the woods, and I would let the market put in a signal of a trend change. I would let the market fall, let the capitulation happen, let it happen on volume, scare away most of the willing participants, and therefore, when that time comes where the market begins to turn, whether it's intraday or based on a daily candle, that's when I would be a willing participant to step in on the long side, buy the market for a nice multi-week or potentially more rally off lows. That will be a situation where a lot of different stocks, a lot of different companies, a lot of different markets across the board will be on sale. So net, I'm looking for lower prices. That's what the look of the chart says to me. Lower prices coming in the S&P 500. However, we still have to be aware that higher prices are not off the table, but it certainly has become suspect. And here's what we'll say. Until and unless we can close a day above this black line right here, all bets are off for the upside. Likely story is we head lower. And the question is this the time that we make new lows or not? And we'll have to see over the next day or so. My guess is, and it's not really a guess, I would say that we're absolutely going to test this level down here, and that will be make it or break it for the market. Testing that and holding that leaves the upside intact. Testing that, breaking through that, opens the floodgates, I believe, to new lows to complete this corrective move. The IWM, you'll notice where the top end of the IWM was today. Look at the upsloping trend line that comes over for all the way from 2011. This trend line. Today's high came right to the underside of that trend line. We did close the month of April below that trend line, so we could classify it as a failed breakout once again. We've already been there, just double checking that we weren't able to rally back to close above that trend line before the month of April was up. However, what was interesting today in the IWM, and I think this is one thing that we have to take note of, and while we may not be able to put it to use right here this minute, these things do come into play more often than not. And when we see things like this on the charts, during the day we saw IWM up. We saw IWM significantly outpacing the rest of the market, while the rest of the market, the S&P 500, the Dow, the NASDAQ, they were down. The IWM was up. When you look at an intraday chart, this is a 10-minute chart. The close of yesterday was 154.04. So let's just put a line in at 154. Okay, this is where the market closed yesterday. We opened up today right here. This is the opening of today. So we opened up today and we went higher. We traded sideways after the Fed announcement. This is where we topped out, and this is where we rolled over. Okay. However, we were up all day long. We were never in the negative today, other than maybe a portion of the first minute of the day or the first candle of the day. But that's irrelevant. The point is that the IWM, the Russell 2000 index, was leading the market on the upside today, telling us, trying to give us a clue that higher prices were coming, was trying to lead the market in the upward direction. Look at this against the spider. Where was the opening of the spider today? Look at the spider chart. This black line represents where we closed yesterday. We closed at 264.99. Call it 265. We traded below that level all day today. And then we popped above it when the Federal Reserve had their announcement. That was a euphoric spike. Just for a minute or two, that was it. The S&P 500 went up, 7 or 8 points. Spiders went up 80 cents, something like that. And then we rolled right back over and finished near the lows of the day. But we were down below yesterday's close in the spider all day long, as opposed to the IWM that was above. Was the IWM trying to tell us something? Normally it does. The problem I have today, and this is a puzzle piece, it goes on the table, but the problem I have today is the transports were down. So I have the IWM, my favorite market leading indicator, is telling us the market's going to rally. And then I look over at the transports, and the transports are down 1% or 100 points, saying, hey, there's trouble on the horizon. You go over to the daily chart of the transports, and there's not a lot of good going on here. This is a big, long swath of sideways, bearish consolidation in a channel. We had a down move, and we've just been trading in this channel. This is a range-bound market until we break to the bottom side or out of this channel on the top end. This channel is pertinent. When you go over to the weekly chart, this is the channel. I mean, look what we have. This is a bear flag pattern. This is bearish consolidation. It's a bearish wedge pattern. Call it anything you want. Under normal market conditions, these patterns continue to the downside. An initial move was down. We go back and forth, trading in a range or a channel for a while. In this case, it was for quite a while, a few months. And then, generally speaking, this is going to break to the downside, and that's where it's going to finish off. So, unfortunately, we had a divergence today between the transports and the IWM, so I have to put them both on the table. One of them is telling us something. One of them will catch up with the other markets. So if the IWM was wrong today, and we are going to actually go down, the IWM was a fake out, let's just call it, then the IWM will catch up to the other markets on the downside. If, in fact, the IWM was the canary in the coal mine, and the markets are going to continue up, last Wednesday's low is going to hold, we're going to have a nice turnaround and finish off, or at least get a lot of that C leg of the ABC pattern complete. If all that's going to happen, then the IWM would have been the tip-off today. It would have been leading the market ahead of time, hence my favorite market leading indicator. And then the other markets, the transports, the Dow, the S&P, the other markets that we follow would have to catch up on the upside, and that's not out of the question. That's happened before. It's going to happen again. However, today, we just don't know which one is going to play out. Which market is going to have to catch up with the other, and we just don't know yet. It's inconclusive. There's not enough evidence, so we just put the pieces to the puzzle on the table, and we have to give it another day. Just from the look of things, the S&P 500 says lower. That's just from the look on the chart. The chart is telling me lower. However, I know I have a line in the sand. As long as we stay above last Wednesday's low, there's still a glimmer of hope that we could see another surge to the upside. That hasn't happened. The chart's telling me lower, but it's not definitive yet. There's not enough certainty in my position that the chart looks like price wants to go lower. That's what it looks like, but I'm not placing a wager on that. I'm not ready to put capital behind that call just yet. We'll see what the next day or so brings. Tonight, let's take a quick look at the Qs. Here's a picture of the NASDAQ, the QQQ. So, from the daily chart perspective, does this look bullish or bearish? Here's where we are, okay? We're below the 50-period moving average, below the 100-period moving average, right up against the 20-period moving average, and we've been consolidating over the 200-period moving average in a bearish wedge formation. Sound familiar? It should sound familiar. It's a familiar look on a chart that we've seen in other charts. And this is telling us something. When all charts begin to look identical, that's because they're trying to tell you something. They don't look identical, or they don't all start to form bearish patterns or bullish patterns by themselves without the chart's intent on telling us something is coming. So the daily chart, doesn't look all that healthy. And when I go to the weekly chart, I see on the Qs, I see a very ominous pattern. I see a big down move, and I see us for the last, 6 or 7 weeks just going sideways. This is the same bearish pattern we just looked at on the daily chart, of course. But on the weekly chart, you can see how it doesn't even look as nearly as sloppy as it does on the daily chart. It actually looks somewhat tight, even though it's not the tightest bear flag pattern I've ever seen in the world. It consolidating underneath the 20-period moving average in a pretty narrow range, all things considered. This is telling us that price wants to go lower. This is telling us that there's another leg down coming in the Qs, in the NASDAQ, across the markets. The only way that this gets taken off the table is a close, a weekly chart close above this level right here. Until and unless we can close Friday afternoon above 169.22, which is quite a distance from where we are. Now, if that's happening, there's a move on, and we've missed a portion or a large portion of the move. I get all that. This is the give and take with trading. You know, if you're waiting for some kind of confirmation or you want the highest probability trade on the board, sometimes you're going to miss trades because you're waiting for confirmation. You want to take the trade with the highest degree of certainty you can. And what's unfortunate about that is you can't have your cake and eat it too. In order to take a trade with the highest degree of certainty you can have, in most cases, there's exceptions to the rule, but in most cases, in order to do that, you have to be able to accept that you're going to make less money on the trade. More certainty, less money for profit. That's the trade-off. If I'm going to wait, then I'm going to make less money. If I'm going to sell at the optimum time to make the most amount of money, or buy, either way, if I'm buying the market or selling the market, am I going to do it at the optimum time to make the optimum profit? If I am, if that's the case, then I'm obviously taking on more risk than if I did the same transaction with more certainty. With more certainty, I'm going to make less money. If you want to make more money, you have to take on more risk. That's just the way it works. While we're on the weekly chart, we take a look at the broker-dealer. I mean, I don't have to say anything more. This is a bearish pattern, no two ways about it. And by the way, in intermission for a second, I want to thank everybody for the comments, for liking the videos, for sharing the videos. It's important to me. I want to build the community. I'm interested to help as many people as I can. I love when we get the interaction going. I want to hear your comments on the market, your comments across economies, things that I'm not seeing, things you're seeing, things you want to take a look at. It's an open discussion. Let's continue to have the open discussion. And I'm in a pay it forward scenario. So I'm paying it forward by making these videos. You can help me out by liking the videos and sharing the videos with someone that you care about that you think can benefit from this information. And by the way, if you want a better and clearer picture and understanding of how the markets really work, then you really need to come over and check out the course at LazyEMiniTrader.com. There have been a lot of people that have taken this course as a result of these videos. They see me giving portions of a lesson. They see me giving snippets, and they want to learn more. And then the emails I get back after the fact are, holy cow, it is truly amazing how we view the markets completely differently after taking the course and opening up a whole new world on how to look at charts. So back to the XBD. Nothing happened today in the XBD. It's still a bearish pattern on the weekly chart. It's still below the moving averages, the 20 and the 50 on the daily chart. But nothing really took place today. But where it did take place was in the XLF, which is the financial sector SPDR ETF. And what's interesting is that it was down over 1% today. And you can see here that we've just flirted with this 200 period moving average far too long, far too many times. We've been hovering, we've been hovering above this 200 period moving average for far too long, where this is a channel, and this channel ultimately will break to the downside. If it doesn't, here's what I will tell you. If it doesn't, and this actually, and all markets, right, they're all going to have to do it together. This is going to have to be a joint effort. If this bearish pattern is going to fail, and this energy is going to be released to the upside, and it's going to happen in the XLF, and it's going to happen in the NASDAQ, the triple Qs, and it's going to happen in the SPDRs and the Dow. If it's going to happen, and it's going to happen across the board, I'm here to tell you that we're in for one heck of a rally higher if that takes place. Barring what the charts are telling us, and the charts are telling us there's still one more leg lower coming. That's not going to happen, and we're going to release that same energy that's saying another leg lower is coming. If that energy is going to be released on the upside, then watch out, because that's going to be one heck of a rally on our hands. I think that's possible. I don't think that's probable. I think there's one more leg down, and when you look at the XLF, what do you see? You see a down move, You see a bear flag pattern, call it whatever you want, bearish consolidation, bearish wedge formation, whatever you want to call it. That's telling you that price wants to have another leg lower. We know the story with the financials. If the financials are selling off, it's unlikely we're going to have the rest of the stock market rallying in the other direction. It's unlikely that's going to take place. In fact, it's more likely that that doesn't take place. If the financials are falling, the likely story is that the rest of the stock market is falling as well. Doesn't necessarily have to be hour by hour, minute by minute, day by day. But in the big scheme of things, if this pattern is going to play out in the XLF, and the XLF is going to come down to, let's just say for argument's sake, $25, right down here in this neighborhood, okay, 25 and a half. If we're going to come down somewhere in that neighborhood, then you can bet your bottom dollar that other markets have been doing the same thing at the same time. Another market that's weak of the technology sector, the SOX. So here's the Philadelphia Semiconductor Index, and it's showing weakness. We're hovering right above the 50-week moving average, right? Keep in mind, weekly chart. Go to the daily chart and you'll see we're consolidating back and forth, just going back and forth through the 200-period moving average. The longer and more we do that, the more susceptible the 200-period moving average will be to give way and lower prices will be ahead in the SOX. What's the weekly chart telling us? The weekly chart telling us that as long as this 50-week moving average holds, then we can go sideways for a while longer. But if this doesn't hold, if that doesn't hold on a weekly chart closing basis, look out below. But even on an intra-week basis, we can come down and test 1200. Testing 1200 in the SOX, the low here is 1203.66. That's an important pivot low. So we can come down and test 1200 intra-week. Now it's still, 55, 60 points away lower than we are now. So you figure if 12 or 13 points is 1%, you can see that that's a pretty good move lower from where we are. So that would scare markets pretty good. We don't have to close below the 50 after the week is over, but intra-week, getting down that low, that would scare some folks. Check in with a couple of stocks that are hedge fund favorites, industry or Wall Street darlings. Here's Amazon. So a few days ago, Amazon reports earnings. They have a gap higher. They gap above and get above the previous closing high. So the previous closing high, or the previous high, not even closing high, the previous high was right here. So we got above that, but yet we closed back below that level after the day was over. That's an ominous sign. That's negative for Amazon. Again, don't take this the wrong way. Love the company, buy their products all the time, just looking at a stock chart. So here's a down move, and now we've been going sideways, right? So is this telling us that there's another down move coming in Amazon, and that down move would likely come all the way down here to do what? Conveniently fill a gap, okay? So if we were to play this pattern out, so we have a gap and crap, go sideways for a few days, have another move lower, fill a gap, do a reset, see what happens. There's another gap down here. At some point, that's going to be filled as well. Take it one day at a time. Amazon, after the gap and crap, doesn't look all that great. Just saying. Facebook, on the other hand, Facebook doesn't look too bad. Facebook is trying to break out above its moving averages. 20, 50, 200, 100. Closed on the 100 today. Peaked above it. We got up pretty high today. Got up to 178.08. $2 higher than we closed in Facebook, but we did not or were not able to close above all the moving averages, but it's trying another couple of days up here, consolidating up in this range, and it's going to want to make a run to fill a gap similar to what we just talked about, only this one is on the flip side, up here near 185. That's a gap that will at some point need to get filled. Right now, we're finding resistance at the beginning of the gap. This is the opening of the gap. This is the closing of the gap. sometimes referred to down here as gap window. We're flirting with that, and if in fact we can consolidate and build enough energy to get into this window, okay, they'll go and fill the other side of that gap. Netflix. So interesting on Netflix, we have a tail low, so if that holds, that could mean that that's a more definitive low or longer term low, but we're also making a bearish pattern inside this last breakdown candle. So we have conflicting data. So we basically have a down move, bearish pattern with a tail in the middle. You know, it's one of those things where the pattern would look great only if I didn't have that big tail low. Well, I do have that big tail low. So I wouldn't do anything with this pattern. I'm not shorting Netflix. I'm not going to be long Netflix because in order to be long, in order to really get momentum to the upside, you have to get above and close above on a daily chart this level here. Until and unless that happens, technically speaking, this bearish pattern would put pressure to the downside of the market. Your sticking point is this tail right here. Had that not happened, this would be a much more clean bearish pattern to short from. But you have this tail candle here, and that puts a little bit of a murky twist on things. Google L. Here's one below the moving averages. Bearish pattern, same thing. Again, everything that I'm going over here. Moving averages, bearish pattern, bullish pattern, whatever pattern. All this stuff is discussed in detail in the course at Lazy E-mini Trader. If you really want to learn how the market works, how it operates on a daily basis, and how to make money from it, then you need to come over and check out that course. It's serious business. It's real information. It's not the stuff that you're going to find on blogs and ebooks floating around the internet. So back to the Google chart. So this is telling us lower prices are expected, right? And the only way out of that is to close above this level right here on a daily chart. So barring that, as long as we continue to consolidate down here beneath the high of this breakdown candle, then this is susceptible to lower prices. So everything we're looking at is pointing to lower prices on the chart. Only we're not really seeing lower prices on the chart. We have fits and starts, and the market's just finding it difficult to complete what I think is a completable down leg that has yet to complete. Gold market. This is the weekly chart. Let's go back to the daily chart. And what you'll see in gold is we closed below 1309 spot 50. So that was the bottom portion of the channel. The top portion of the channel's on top. Here's your bottom, right? We've been talking about this for a while. Here's your top of the channel. As long as we were going back to the top of the channel, we needed to stay inside the channel. Now we've broken out to the downside or the bottom portion, or broken out from the bottom end of the channel. So that's a negative. So does that tell us lower prices are guaranteed? No, that's why we don't buy, or that's why we don't sell into breakdowns. We don't sell the break. That's a dumb trade. That doesn't work most of the time, okay? But it certainly tells us things are weak in the gold complex. We haven't had, or I haven't had, a good read on gold one way or the other in a while. Getting a couple of things saying, you know, here's a bearish pattern, here's a reason to be bearish, flip side, here's a bullish pattern, here's a reason to be bullish. The problem is we never had anything really definitive enough to say, I'm putting my capital to work in gold because here's the highest likely scenario. This is the probability of what's going to happen. And we haven't had that in quite some time. Now we're back below this channel. I think it's negative. I wouldn't want to be long below this channel, and I'm certainly not shorting in the hole. We talked about that before. So let's just see what happens with gold. Maybe at lower prices we may find the buying opportunity, but right here, right now, doing nothing with the yellow metal. And in crude oil, crude's doing exactly what we said it would. It came back to retest the 20-period moving average, or home base came up toward price. Either way, markets don't like to stray too far away from home base. Listen, there's nothing wrong with this market. This is in a sideways trend. It's an upward trend. It's going sideways, eating time off the clock, building energy to make another push higher. I stand by the call that we had from a long, long time ago $73 to $74 a barrel, up in that neighborhood, I will be looking for a signal of a trend change at that time. Whenever that does occur, whenever we get up there, my antennas will go up. I will be looking for a signal of a trend change. You don't have to be the first partier to the party. You don't have to be the first one there. As long as you're there when everybody's having fun, there's plenty of meat left on the bone. Once I see the market reverse, I will let you know that I am short crude oil. I think it could be a wonderful short trade opportunity that could be a multi-month trade. And with that, it's everything I wanted to and intended to discuss. I got long-winded tonight. It's a longer video than I really should make. However, I am going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.